Okay, we're going to get started. Hi everyone, thank you so much for joining us. My name is Nia Evans and I'm from the National Women's Law Center, and I will be the moderator for today's webinar, What You Need to Know About the Trump Child Care Plan. I have just a few technical notes before we begin the presentation. I want everyone to know that all lines will be on mute during today's webinar. We will be taking questions after our presenter is finished, but we really do encourage you to submit questions throughout the webinar. You can submit a question by typing it into the designated area on your control panel and hitting send. As a reminder, we will be recording today's webinar. You will be receiving a link to a recording of the presentation within the next few days. At this point, I'll turn it over to Helen Blank, our Director of Child Care and Early Learning, for a quick introduction. Take it away, Helen.
Thanks, Nia. Hi, everybody. I'm very happy to be here with my wonderful colleague, Amy Matsui, who knows everything about tax credits for women and children. And we are excited that child care is an issue that both campaigns talked about. It's been a long time, but we obviously are not excited that the Trump child care plan is very limited, and we need to really work hard to push out to get something that truly helps both children, families, and the child care workforce now that child care is a bigger focus on the national agenda. And Amy's going to tell you why we have to move this issue in another direction.
Thanks so much, Helen. This is Amy Matsui. I'm Senior Counsel and Director of Government Relations at the National Women's Law Center. And we want to thank all of you today for taking the time to talk about taxes and child care, which we're all looking for ways to make sure that families are able to access the child care that they need to go to work and go to school. And we want to talk about the proposal that's on the table from the Trump administration, their proposal for doing that, and then some thoughts that we have about the plan and trying to target the benefits, as Helen mentioned, more to low and moderate income families. So before we get started kicking off the webinar, we wanted to find out a little bit about all of you, and so we have a couple of quick poll questions that we want to turn to. Thank you so much, Nia. So the first question, we wanted to know whether you are an advocate, an interested member of the public, a policymaker, or a student. So if you could please take a moment to select one of those options, we will be able to look at the poll results in just a moment. All right, thank you. Nia, are you able to pull up the results? Great, so it looks like most of the folks on the call today are advocates, and hopefully we're going to give you some tools that you need to be able to move forward in your advocacy. Thank you, and let's go to the next question. So the second question that we had for you before we get started is what you're hoping to take away from today's webinar. We are wondering whether you want to know just what is in the Trump tax plan for child care, how the Trump plan is different from the tax benefits that we already have, what policies would help families with their child care needs the most, or all of the above. Please take a second to answer the poll questions, and then we'll look at the results. Thank you. So Nia, it looks like you're going to be able to pull up the poll questions. So it looks like all of those things are elements that you're hoping to get from today's webinar, and hopefully we'll give you the answers that you're looking for. Next slide, please. So on the first slide that we have on, I wanted to give a little bit of a background about just the existing child care tax benefits that are already available to families and to businesses. So there are a number of tax benefits that are intended to help families meet the cost of child care and also kind of help with that employment-related piece as well. So the first of these is a tax credit for families. The Child Independent Care Tax Credit is meant to help families meet the cost of the child care that they need to work and in some cases go to school. It's more valuable for lower income families, and it's based upon the amount of child care expenses that a family has multiplied by a percentage which is tied to their income. Unfortunately, the Child Independent Care Tax Credit is not refundable, so it's not available to a lot of low and moderate income families. But over 6 million tax filers receive benefits from this tax credit every year. In addition to the Child Independent Care Tax Credit, families can use dependent care assistance plans if they're offered by their employers. So employers have the option of either giving their employees direct benefits dealing with child care, or they can offer savings plans like a flexible spending plan where employees can put up to $5,000 of income from their payroll, from their paychecks before taxes, and then they can use those funds to pay for child and dependent care expenses. This works together with the Child Independent Care Tax Credit, so you can't claim both of them for the same expenses, but you can claim $5,000 of benefits under a dependent care assistance plan and then a remaining $1,000 maximum under the tax credit. In addition, there are 2 tax benefits that are for employers that I wanted to mention today. The first is that there is a federal tax credit for employers that provide child care benefits for their employees. And this, not unreasonably, is called the Employer-Provided Child Care Tax Credit. Employers who either offer slots or pay benefits for their employees or can contribute to child care centers or to resource and referral agencies can receive a percentage of those expenditures back in the form of this tax credit. And in addition, employers can also deduct some expenses that they pay related to child care as a regular business expense. So those are different ways that employers can receive tax benefits for helping their employees with the cost of child care that they need to go to work. These are all federal benefits, but in addition, there are also state versions of many of these tax benefits. Next slide, please. So today, most of the presentation, we want to focus on the Trump administration's child care plan. So just to kind of give some general background about this, we're basing this discussion on materials that were put up by the Trump campaign in approximately September last year. So just as kind of a general background on this, it's possible, that these were campaign documents. Some details remain a little vague, and they certainly may change as a proposal gets more fully put into place. But we are going on kind of the best available information that we have from September and October of this past fall. So the child care plan that the Trump administration has proposed has a couple of main components. The first of these is for families, and it is a deduction for child care expenses. In addition to the deduction, there's something called a child care expenses rebate, which is meant for low-income families. And then the other component, which is directed towards families, are a new kind of savings account called the Dependent Care Savings Account. Further, there is something called, there are a couple of employer-related tax incentives that I will also cover as part of this presentation. So in addition to just kind of saying generally that these proposals are possibly going to have some things that change, I also wanted to say that the child care tax components that we're going to be talking about here should be thought about in a broader sense, in that the Trump administration has proposed a broader income tax reform plan. So a couple of relevant pieces from that are that the number of income tax brackets, there are currently 7, which exist, are going to be reduced under the Trump plan to 3 tax brackets, so that the income tax brackets are going to be reduced. In addition, the Trump plan would eliminate the head of household filing status, which is a filing status which is for single parents with children, and the dependency exemptions, the exemptions that can be claimed for each child or dependent, would also be eliminated under this proposal in favor of a changed and more expansive standard deduction. So the components of Trump's child care plan that deal with tax benefits are in the broader context of a larger income tax proposal. Next slide, please. So before we get started jumping into the substance of the child care tax deduction, I just wanted to make sure that we're all on the same page with what a tax deduction offers to families. So a tax deduction is taken on a tax return, which is filed in the spring, or starting now actually, of the following year after the child care expenses have been paid. So you will be filing, if you haven't already, your 2016 tax return, and so now where we are in 2017, you would be filing to get the tax benefits after your child care expenses were paid last year. The way that a deduction works is to reduce taxable income, and the taxable income is what is multiplied by your tax rate to give you the amount of taxes owed. So if you lower your taxable income by taking away, by deducting a certain amount of expenses, then the eventual tax burden, or the tax which is calculated, is going to be lower as well. Since this is the way the deduction works, what's the benefit that you get? So what you get is tax savings, and therefore the value of the deduction is greater if your tax rate is greater, and we call that the marginal tax rate. So just to say that again, the value of a tax deduction is based on your marginal tax rate. So tax savings are greater for higher income families because they have higher tax rates. And then finally, the important thing, another important element of a tax deduction that is important to remember is that a tax deduction only has value if a family has tax liability. Because 0 minus 0 gives you 0, a deduction is only valuable if it helps reduce the amount of taxes that you owe. Next slide, please. So the Trump administration's proposed deduction for child care expenses is as follows. For married couples who are filing jointly and have incomes of $500,000, half of that for single filers or less, these families could deduct child care expenses, tuition for private preschool or nursery school, or expenses for enrichment activities for their children. And this amount of deduction would be capped at the average cost of child care in their state for the age of the particular child for up to 4 children. So let me break that down a little bit more. So families could kind of tally up their expenses at the end of the year for child care, for private school, nursery school, or preschool expenses, or any kind of activities that would fall under the category of enrichment for up to 4 of their children. And for each of these children, the amount of expenses that could be deducted is capped at the average cost of child care in their state for the age of the child. So just to be clear, we don't know exactly what that is. There are some calculations done by different organizations, notably Child Care Aware of America, who every year look at the average cost of child care by state, and also looking at the kind of setting, whether it is a family child care home or a child care center for infants, and then also for preschoolers. So we do have some information about different levels of child care expenses in states, but it's not entirely clear what measure this deduction would use. So in addition to just kind of these basics about what can be deducted by whom and for what, families with either stay-at-home parents or with, and the example that was given in the campaign documents was grandparents who provide child care at no cost, could also claim this tax deduction. So there is a provision in this proposal under which families who don't have any child care expenses out of pocket would be able to claim the deduction for child care expenses. One thing which is also not entirely clear from the proposal is whether families have to have out-of-pocket expenses or whether just this average expense per child age per state is the amount that would be deducted. So that's something which needs to be clarified going forward. And then I did want to clarify that you know from filing your own taxes that there is a standard deduction, and then there are also itemized deductions. If you have, for example, mortgage interest or charitable deductions, you can only claim those by itemizing your deductions. The child care expense deduction that has been proposed would be what's called an above-the-line deduction, which means it would be taken before either the standard deduction or itemized deductions were taken, and that would enable more people to be able to benefit from the child care deduction that was proposed. But either way, even as an above-the-line deduction, a family needs to have tax liability in order to have the deduction be beneficial for them as a tax matter. Next slide, please. So as I mentioned in the kind of the basics on tax deduction slide, the value of a tax deduction is based upon your tax rate. And so the larger your tax rate, because your income is higher, the more valuable a deduction is for your family. And this is just an example of that. So remember that the deduction is capped so that families earning under $500,000 for a married couple can claim the deduction. And here, I just wanted to give a couple of examples of what the deduction would be worth for families at different income levels. So for a family with $250,000 of income, if they spent $6,000 on child care, because their tax rate under the Trump plan is 33%, the deduction would be worth $1,980 for them. In contrast, a family with $75,000 in income who would have a tax rate of 25% with the same amount of expenses would have a deduction worth $1,500. And then for a family with $50,000 of taxable income who similarly spent $6,000 on child care, because their tax rate is only 12%, the deduction would only be worth $720 for that family. So as you can see, the value of the deduction is tied directly to the level of income and the tax rate, and it is worth more for higher income families than for lower income families. One other thing that I want to point out is that under the Trump proposal, the existing tax benefits that I mentioned in the first slide, the Child Independent Care Tax Credit in particular, would still exist. And so for many families, and particularly for middle income families, the Child Independent Care Tax Credit would be worth more than the deduction depending on their tax rate. So that's just something I wanted to highlight for you. Next slide, please. So because the deduction only has value for families who have tax liability, the proposal makes a special circumstance for families who don't have any tax liability. So the proposal does attempt to address the needs of lower income families, and specifically those who don't have tax liability. So just as an example, under current tax rates, families like a single mom with 2 children who earns in the $21,000 to $22,000 range doesn't have any tax liability, and so would not be able to benefit from a tax deduction or from the child care and dependent care tax credit as it currently exists. So under the Trump proposal, married couples filing jointly with incomes of $62,400, half of that for single taxpayers, or less, could receive what is called a child care spending rebate. And it says specifically in the proposal that this is for families who have no tax liability and therefore can't benefit from the deduction. Unfortunately, the spending rebate provides much less help than the deduction. It is supposed to be added on to the Earned Income Tax Credit, or EITC, and it's calculated as 7.65% of whatever the eligible or remaining child care expenses that the tax filer has. So you will notice that 7.65%, first of all, is not a very big percent, and second of all, is worth less than the deduction at every tax bracket, and those tax brackets are 12%, 25%, or 33% under the Trump plan. So the rebate is smaller as it's calculated by a percentage than the deduction at every tax bracket. In addition, the rebate is capped at half the payroll taxes paid by the tax filer or half the payroll taxes of the lower earning parent in a two-parent household. The campaign calculated that the maximum value of the child care spending rebate would be about $1,200. Next slide, please. So just to give you an example of what that might mean. So for a single mother who had adjusted gross income of $15,000 and who had $6,000 in child care expenses eligible for the child care rebate would receive a rebate of only $459. So that is 7.65% of $6,000. So honestly, it's a very small rebate compared to what that mother has paid out in child care expenses during the year and offers very little help against that, even though obviously for many families any tax benefit is going to help them make ends meet. So in addition, because families have different levels of income and it's hard to estimate how the different spouses' incomes are going to be related to each other, and so estimating what the cap is and tax liability and whether or not there are going to be other deductions that are allowed under the Trump tax plan, it's a little difficult to figure out how a family could receive the theoretical maximum of $1,200, which just as a straight-up calculation is 7.65% of $15,000+ in child care expenses. So it is a little unclear how many families would be eligible for this theoretical maximum. But the bottom line is that the rebate, even though it's targeted towards low-income families, would provide very little assistance to the families who need the most help paying for child care expenses throughout the year in order to work. Next slide, please. So in addition to the tax deduction with the child care spending rebate, which is a part of that piece of the proposal, the Trump plan offers what they're calling dependent care savings accounts. So you'll remember that I mentioned that under current law, employers can offer a dependent care assistance plan for their own employees. Under this proposal, people could open dependent care savings accounts regardless of whether or not their employer offers one. These accounts are intended to pay for child care expenses for specific individuals for children up to the age of 18. And I should mention that both the dependent care savings accounts and the tax deduction do have a component which addresses elder care expenses, but we're going to be focusing on the child care expenses aspects of them in this presentation. So for the dependent care savings accounts that have been proposed by the Trump administration, there's no income limit for families. So families earning $1 million or $2 million could participate in opening dependent care savings accounts just as could a family earning $50,000. In addition, you'll remember that the child care expense deduction was limited to 4 children, and there's no such limitation in the campaign documents for dependent care savings accounts. The way that the accounts would work is that after an account has been opened for a particular individual, immediate family members, the person who opened the account, and employers could contribute a total of $2,000 per year per account. The contribution would be excluded from tax, so whatever amount of income is used to calculate tax, that $2,000 would be subtracted from it. In addition, the amount of just the increase by investment or appreciation in the account balance would also not be taxed. And it's not clear from the proposals whether the account balance would be taxed when funds were taken out to pay for expenses. Because the dependent care savings accounts could accumulate from year to year, unlike current law dependent care assistance plans, they wouldn't have to be spent in the same year and they could grow over time. Like the deduction, the funds that are in a dependent care savings account for a minor could be used to pay for expenses for child care, but also for private school tuition and enrichment programs. People can contribute to these dependent care savings accounts until a child turns 18. And at that point, if there are funds remaining in an account, they could be used for higher education expenses. So this is kind of the 101 on the dependent care savings account proposal. Next slide, please. So I wanted to talk a little bit about how the dependent care savings accounts provide tax benefits for families who are able to participate. So as I mentioned, when people make contributions to dependent care savings accounts, they're putting income in which then does not get taxed. It lowers their taxable income, and thus their tax bill is smaller, and they'll figure this out when they file their tax return in a particular year. And in addition, the growth in an account fund from the investments would not be taxed while it's in the account and possibly ever. So just like a deduction, the tax benefit that families get is based on the family's marginal tax rate. So it is more valuable the higher a family's income is. But in addition, if the family doesn't have any tax liability, there is limited value to a dependent care savings account. As I mentioned, people can use the accounts to pay for expenses in the year that the contributions were made or in any year thereafter. But at the end of the day, the money that is in the account is still money that families took out of their own paychecks. So they're using those accounts to get a tax benefit, but it's still their money that was put in. So as many of you know, families who are on tight budgets will find it difficult to contribute to these accounts, certainly not up to the maximum amount. So they could really serve as a significant new tax shelter for families who have the income to put in them. And instead of the image of the family that this kind of proposal is meant to benefit, which is a working family struggling to make ends meet and pay their child care bills throughout the year so that they can go to work, these accounts could be used by very high income families to pay for horseback riding lessons or violin lessons and get a tax benefit from that. So it's not a well-targeted proposal. Next slide, please. There is a component of the Trump dependent care savings account proposal that is meant to help lower income families. This part of the proposal is a little vague on details, but the proposal says that some lower income families could receive up to a 50% match of up to $1,000 in contributions to a dependent care savings account per year. So what does that mean? That means that if a family makes $1,000 of contribution, at the end of the year when they file their tax return the following year, they would theoretically be able to receive a match of $500. Unfortunately, as I mentioned, because of the kind of tight budgetary constraints that families are under, they may find it very difficult to contribute at all to one of these accounts. And there was a study done a couple of years ago which offered families a 50% match if they contributed to a tax-favored IRA at tax time. And only, under 15% of lower income families participated to get that match even when it was offered to them. And so the lesson that we take from that is that even when there is a match, it's very difficult for lower income families to participate in this kind of savings account. The proposals in the campaign document suggest that families could use if they get the EITC refund or another refund, that they could use those to make a deposit for the next year's dependent care savings account contribution. But again, as many of you know, families use their tax refunds to pay current debts. They use them to pay debt that's long due and past due bills, or to make large purchases. And so it's also not the most feasible way or reasonable to expect families to use the tax refunds that they need to kind of keep their families afloat and pay for large purchases that they need, medical expenses or other things, to pay themselves for future child care expenses using a dependent care savings account. So the bottom line is that the benefits are much greater from these accounts for higher income families, and even with the match proposal, lower income families will get little or no benefit from dependent care savings accounts. Next slide, please. So I also wanted to just reiterate that the existing tax benefits that I mentioned at the beginning of the presentation, the Child and Dependent Care Tax Credit and the Dependent Care Assistance Plans, would not be eliminated under this proposal. So how would that work? So for the deduction, if the percentage that a family would get of expenses under the Child and Dependent Care Tax Credit is greater than their tax rate, 12, 25, or 33%, then it would make more sense for them, if they have tax liability, to take the Child and Dependent Care Tax Credit. And that's what I meant when I said that many families might get more benefit from the existing Child and Dependent Care Tax Credit than from a new deduction. And but for families who have more expenses, or in the case of the savings accounts, have more income that they can afford to put away in tax-preferred savings accounts, they would be able to benefit by using several of these tax benefits at the same time to cover a wide range of expenses. And remember also that the definition of expenses under the Trump proposal is broader than under current law, in that you could not only use the funds or deduct expenses for child care and some private school tuition, but also for enrichment expenses, which is not narrowly defined or defined at all in the proposal documents. So as long as families don't double count expenses and try and use the same expenses for multiple tax benefits, they could claim a patchwork of them together. And just to kind of reiterate the obvious, higher income families are both more likely to have higher child care and enrichment expenses, excess tax liability, and income that they can afford to put aside and put in tax-preferred savings accounts. Next slide, please. So this is a lot of information, and I know that we are going to have time for questions at the end, but I wanted to just kind of pause at this point and think about how difficult it will likely be for a family to figure out which one of these tax benefits would work best for them. We strongly support families getting as much help and resources as they can paying for to meet their child care expenses, but we also recognize that a tax solution is often not particularly straightforward. A lot of people are intimidated by taxes. Fortunately for low and moderate income families, they may be eligible to get free help preparing their taxes through volunteer income tax assistance programs or through free file programs offered through the IRS, but tax solutions and tax credits are not a particularly easy way to get benefits to families. So we wanted to ask you whether you think the average person would be able to figure out how to take full advantage of these child care tax benefits if new ones were offered through the Trump tax proposals. So you can check one of the following. I think people could do this on their own, maybe with TurboTax. I think people would need an accountant, or I think people would get confused. So if you could take just a moment to answer the poll, we will look at the results in just a moment before moving to the next part of the presentation. Okay, Nia, if you could show us the results, please. So you might have been able to tell that I tend to agree with you. I think that a lot of people would get confused when there are multiple tax benefits. So this is reflective of, if these kind of more complicated tax benefits are available, it really does contemplate that people would have assistance tax planning, tax preparation, and that's just a resource that a lot of low and moderate income families don't have. Next slide, please. Thank you. So what we want you to take away from this description, possibly much more in-depth than you were ever hoping to hear, about the Trump child care tax proposal is that the way that the proposal is structured provides the most benefits to higher income families, but it does little for the families who need help the most. In addition, because the proposal goes through the tax system directly to families, the proposal would not do anything to help other aspects of child care that families are really searching for help and support and resources for. This includes improving the quality of child care that's available, paying the badly underserved child care workforce, which currently makes an average of $10.70 an hour, but should be paid much more for the important work that they do. In addition, this proposal wouldn't do anything to help build the supply of child care in underserved areas, whether it is in rural areas or in urban areas. So this is a proposal that has limitations and wouldn't help the aspects of the child care system, which also direly need improvement. Next slide, please. The last part of the Trump child care proposal that I wanted to talk about today are the employer tax incentives. So there is a two-part proposal which is described as having the goal of encouraging employers to offer child care to their employees on site. So just think about that for a second, that this is something that would only help the employees of whichever employer has decided to do this, which may be a limited pool of people, and the proposal itself also acknowledges that this is probably something that larger employers are going to be able to take advantage of rather than small businesses. So the first part of the proposal, which would affect employer tax incentives, would change the existing employer-provided child care credit. So the proposal said that it would make it make it a better incentive for employers to offer on-site child care by increasing the amount that an employer could claim for the credit, which is currently $150,000, so it would look to expand that. In addition, it would shorten the period of time that a child care center has to be open before the benefits of the credit could all be taken. And third, there's not a lot of description for how this would happen, but the proposal says that it wants to devise ways for companies to pool resources to open child care facilities and then benefit from this credit. So I think I may have mentioned that this federal credit has been in existence since about 2001, and it does get claimed, but it's claimed much less than was initially estimated when it was proposed. It's just not clear whether the proposed changes under the Trump proposal would actually make it that more attractive for employers. We've definitely seen on the state level that state-based employer child care tax credits get very little uptake, and we've seen a couple of states where they have a credit and exactly no one has claimed it. So it's not one that has gotten a lot of use. So in addition to improving the federal employer-provided child care credit, the Trump proposal offers to allow businesses the same exclusion from income for contributing to their employees' child care. So this is something that, again, is parallel to the Dependent Care Assistance Program, under which employers can deduct benefits that they give to their employees for child care. And it looks a lot like if employers give contributions to new dependent care savings accounts, if those are enacted, that would probably also be an exclusion that that this part of the proposal refers to. So again, the bottom line is that business tax credits, although they're great if an employer provides them for that corporation's employees, they have not worked well and gotten a lot of uptake in a way to encourage additional child care investments either at the federal or state level. Next slide, please. So there are better alternatives. There have been estimates for how much the Trump child care proposal would cost over a 10-year period. The two estimates that we have seen range from $140 billion over a 10-year period to in excess of $550 billion over a 10-year period. And so if we're looking at that level of investment to help families get the child care that they need, there are alternative ways that that money could be spent. Next slide, please. So the first part of the kind of investment that is incredibly important, both for individual families and for the child care system, is direct child care assistance. The Federal Child Care and Development Block Grant is the largest federal investment in child care, and it allows states to offer direct assistance to families, low and moderate income families up to 85% of state median income, paying for child care. And the way that direct child care assistance works is that it gives benefits, this assistance or these subsidies, to families as their child care expenses are being due, so they wouldn't have to wait until the end of the year to get a benefit. In addition, the Child Care and Development Block Grant is used to support the child care system. So for all families using child care, it helps to pay for health and safety inspections. It helps train the child care workforce. It also helps fund child care resource and referral agencies that help any family find the child care that they need. So the Child Care and Development Block Grant not only directly helps families pay for child care, but also helps support and strengthen the child care that's available to all families. In addition, improving the federal child independent care tax credit, the one that already exists to help families meet the high cost of child care through the tax system, would help more lower and middle income families offset the costs of work or school-related child care. So specifically, making the credit refundable would provide an additional over 1 million families benefits from this tax credit. Increasing the amount of child care expenses that families can claim, which are currently $3,000 to $6,000 for either one child or dependent or 2 or more children or dependents, would also help families meet the cost of actual care, what they're paying right now on the market. In addition, if the percentage of expenses that families receive based on their income is increased, this could also offer more help to middle and higher income families. Right now, the maximum percentage that families, those who are making over $43,000, can receive is 20%. And so if that percentage was increased up the income scale, more families would get more assistance from this credit. And then finally, to make sure that the value of the credit doesn't decrease just over time, these amounts could be increased for inflation. So child care and the Child Care and Development Block Grant, has strong bipartisan support throughout its history, and there is currently a proposal to make the federal child independent care tax credit refundable and improve it in a couple of other ways, which is bipartisan. So these are strategies that have bipartisan support and can help different families in different ways, but we think are a better way to invest the amount of resources that might otherwise go to the Trump tax proposals for child care. Next slide, please. So we're going to, this has been a lot of information. We're going to send you this PowerPoint along with a recording of the presentation and then a couple of resources. So we do have a fact sheet which gives information about the child care tax proposal that the Trump administration put forward during the campaign. And then we also have a couple of other fact sheets about child care and child care assistance that we will send to you by email in a day or two, as Nia mentioned. So with that, we know that a lot of you have asked questions, and we want to take a couple minutes to answer them. And so we can go to the last slide and get started. So the first question that we have is what we know about the average cost of child care per state. So I mentioned earlier in the presentation that Child Care Aware of America looks at the cost of child care by state by the age of the child and by the child care setting. And the range that they found in 2016 was between $3,000 and over $17,000 per year as the age of the child and the kind of setting of child care. And so we know that, $3,000 is at the very, very low end of what families are paying for child care, and that many families are paying more. So this kind of goes to how much folks need for assistance paying for child care. So I'm going to look for a couple of other questions. So another question is, what about, I did talk about improving the Child and Dependent Care Tax Credit, and so someone has asked about expanding the Dependent Care Assistance Plan, or DCAP, that I also mentioned. And so again, just to highlight, and something that I mentioned earlier, is that employers have to offer a dependent care assistance plan for their employees to take advantage of it. And so certainly not all employers do that, and it tends to be larger employers. And then on top of that, the people, even if the dependent care assistance plan is offered, if it is a payroll deduction where people are just kind of making deposits into these accounts from their paychecks, it really is higher income employees who will take advantage of that. In part, that's because they can spare the income. In part, it's because they're not as deterred by the fact that if they don't use the account balance during the year, they lose it, it disappears. And so for these reasons in particular, even though the Dependent Care Assistance Plan is something that is beneficial for the families who can take advantage of it, in a world of limited resources, we really think that after making investments in direct assistance, investing in the credit, which is available to anyone who files a tax return, a 1040 tax return, sorry, that's a more broadly available benefit. Okay, I'm going to look for a couple of other questions. So another question, just to reiterate, someone asked about what stage this proposal is. And so as I mentioned, we have based this discussion and analysis on the campaign documents that we've seen starting in September and a little bit earlier. And we know that there are a lot of discussions that are currently happening around taxes generally. And then, we've seen in the press that there have been visits from members of the administration and Ivanka Trump going up to the Hill to talk about child care, but we really don't know where those discussions are. And so one of the things that we think is really beneficial at this point is if advocates are able to talk to policymakers and just let them know what families need, that families need help meeting the cost of child care that they need to go to work, and that low-income families kind of proportionally need that help as much as certainly, but more than higher-income families as well. Okay. So another question that I saw was whether or not there's a way for a tax proposal to make sure that families could get reimbursed monthly. So this is a tricky one, and it really is something I think that if we were able to figure out as a policy matter how to make the tax benefits available throughout the year, that would really kind of be a breakthrough in a way. There used to be a way for people who claim the EITC to get some of those benefits in advance through their paychecks. But that advanced EITC proposal was eliminated a couple of years ago, I think in 2010. So I think that there are a lot of great minds who are trying to think about ways that a child care tax benefit could get paid out during the year, but with kind of lower, with fewer resources at the IRS and fewer people who are able to kind of administer tax benefits. as well as it just being very complicated, that would mean that a lot of payments were going every month directly to families or directly to providers. It's just a complicated proposition, and we haven't figured out a great way to do it yet, which is not to say that people are not thinking about it, because people are thinking about it hard, but it is a very complicated proposition, excuse me. Okay, so I'm going to look for like maybe 3 more questions. Hold on. So there's a couple of other questions where people are asking about enrichment expenses, and again, this is something that has not a lot of detail in the proposals. What the proposal is saying is that different kinds of enrichment activities for children could have those expenses claimed through either the deduction or reimbursed through the dependent care savings account, but we don't know if any limits are on that. And so if there are no limits, we're giving the example of a couple of the enrichment activities that came to our mind, which are music lessons or art lessons, but even something like horseback riding lessons. And so this may be something that gets more fleshed out as the proposal moves forward through the process, but it is a concern because although those are activities that benefit children and help their development, again, in a world of limited resources, you know, safe, high-quality child care that meets parents' needs to go to work and children's needs to be school-ready seems like it's a greater priority, that we need to be helping those families meet those expenses. And it would be great if we could help everybody with enrichment activities, but we need to be helping the families the most who need it the most. Okay. So I'm going to answer one last question, I think, which is basically about the structure of the deduction. So I think I had said that the deduction is worth more for higher income families, and it's tied to the tax rate. And that is because a deduction basically represents tax savings. If you take a chunk of income out of the kitty, so to speak, then you save the amount of taxes that would come due on that income. So if you deducted $1,000 and your tax rate is 12%, then you have saved $120 in taxes. And so if your tax rate is higher than 12% for that same $1,000, if instead it's 33%, then instead of $120, you save $330 in tax savings. So the way that it's structured, kind of the basics of it, are that deductions are worth more the more income you have, because the higher the tax rate, the more valuable the tax benefit. Okay. So we're going to make sure that this particular, we're not going to have time to answer all of the great questions that folks sent in, but we are going to go through them, and if we, for example, are seeing a lot of questions pop up as we may be able to do like a Q&A or a frequently asked questions, but at the very least, we're going to circulate this presentation. We're going to send all of you the PowerPoint, a fact sheet that talks about the child care Trump proposals that the administration has put forward, as well as a couple of the other materials on tax benefits. And then you can always reach out directly to me if you have a question that hasn't been answered at the Law Center, and my email is amatsui@nwlc.org. But we hope that we've at least given you a lay of the land and some basic information about the Trump child care tax proposals, as well as an idea of at least what in our minds is a better step forward towards helping the families who most need help paying for their child care to get the resources that they need. So with that, I'm going to turn it back over to Nia to close out the webinar.
Yeah, thanks, Amy, so much. Well, thank you again, everyone, for joining us. And just to reiterate what Amy said, we will be sending out an email that includes the PowerPoint slides and a recording of the webinar. Thank you again so much for joining us. We really appreciated your questions, the excitement, the enthusiasm. This will, I'm sure, be the first of many conversations. So thank you again, and we'll talk to you soon. Have a great day.